French bank Societe Generale has been bearish on gold since the start of the year, despite the metal's 15% gains. With gold down this Wednesday, could the bank be onto something? Joining us now on the line from the UK is SocGen's head of metals research, Robin Bhar. Robin, thanks so much for being with us on Kitco News.
Delighted to be with you, and thanks for the opportunity to explain in a bit more detail our bearish views on gold.
Well, that's my first question to you today, Robin. Despite gold losing ground today, the metal's still up as we approach the end of the first quarter, but the bank, SocGen, remains bearish. So why is that?
Okay, why? I think we have to go back to the reasons why gold has really surprised everyone, including ourselves, because we didn't expect this 20% plus rally year to date. Clearly, safe haven flows, investors flocking to gold, buying the ETFs, going long on the futures markets. Clearly, there has to be a driver, and I think the driver has been fear, uncertainty over global economic growth, maybe expecting a recession in the US, maybe also expecting a so-called hard landing or recession in China, a devaluation of the Chinese currency. You know, we can go on and on. I think the list is endless, but clearly I think the key drivers has been the turmoil in financial markets that we had in the early part of this year. We saw some very large falls in global equity markets globally, which pushed them into a bear trend at that time. We had also a move by certain central banks into negative territory, so negative interest rates. I think those are the two big factors, uncertainty and fear of the unknown driving people into gold.
Well, that's my next question to you, really, Robin. You know, with central banks cutting rates into negative territory, is it not more attractive now to hold gold versus cash?
It is, definitely that's the case. But in order for us to remain bullish, we would have to expect all the other central banks to follow the lead shown by the ECB and the Bank of Japan, and we just don't think it's credible for the US Fed or even the Bank of England to go down the same route. And when we look at the Fed, it's very unlikely that the US will go into recession. I think the probability is very low. Certainly has fallen over the last few months when people obviously feared a US recession. So if we're assuming no US recession, then I think the Fed will be faced with a healthy economy. They will see the wage inflation pressures building. Job creation has been very strong. So bottom line, no recession in the US. We think the Fed can continue to raise, albeit slowly, interest rates. And that's really the number one bearish factor for gold, is tightening US monetary policy. So we think the market's wrong, that the Fed is not going to keep rates unchanged this year, and we could be looking at maybe 2, possibly 3 further rate increases, and maybe another 3, 4 rate increases in 2017. We think this will cap the gold rally and push it into a bear market.
All right, Robin. So just to wrap, despite the bank's bearish outlook, would you say there's still a case for gold in 2016, something in the metal's favor?
Undoubtedly, despite our bearish tone towards gold, if you expect the worst and, you know, think that there's more uncertainty, then gold's a fantastic insurance policy. And as much as you have an insurance policy on your house or your car burning down or getting robbed, why shouldn't you have an insurance policy on the financial markets? And therefore, that insurance policy is gold.
Great thoughts from you, Robin. Thank you.
No problem at all. Thanks.
And thank you for watching. We have II Traders Bill Baruch joining us from the CME up next.